Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, July 15th, 2023. And our top story today, stocks roll as earnings roll in. And joining me now to discuss this and a lot more, Jane King is a financial journalist joining us from the NASDAQ. Jane, great to see you. Thanks so much for joining us on the program this morning.
Great to be with you, Jeffrey, as always.
Yeah, well, the pleasure is all ours, of course. Jane, S&P 500 rolling, stocks really rolling this week. I guess earnings have come in and pretty positive results.
Yeah, I felt like we came in Monday with this attitude, with these like whispers that inflation's going to be friendlier than we think, earnings are going to be better than we think, and we just off to the races ever since Monday. And the NASDAQ's on track for its best week since April. We got bank earnings today. They were better than expected. This was from JP Morgan Chase, Wells Fargo, Citi. There'll be some more banks reporting next week. But Chase's CEO, Jamie Dimon, said the economy is resilient. And even though he does see a few things, he said, consumer spending looks to be slowing a little bit. Labor market is softening a little bit, but he didn't seem overly worried about the economy. No more talks of economic hurricanes and things like that. So the markets so far, at least the second half of the year, we've had kind of two mixed weeks, but this was a good week.
Yeah, really resilient. Good start to the second half of the year. Jane, let's talk about earnings for a second. The tech stocks, they really got hit hard. Their layoffs, Microsoft. You go down the list, they were Meta, another one that laid off thousands of employees. It looks like some of these tech stocks, though, have bounced back.
They have bounced back. I mean, it's been really strong, AI driven in many cases. Facebook or Meta's done really well. So you remember during the most recent earnings report, people were mentioning AI, like, every other sentence, these tech companies, even not tech companies. So I'm curious if that's going to continue when they report for the most recent quarter, if they still see AI as, truly revolutionary. Is it maybe hyped? Is it going to take longer than expected? I'm curious where that all sits, or if they're still as optimistic about AI as they were.
Yeah, the darling, Jane, was NVIDIA. How did they, I'm not quizzing you, but I think they actually did have a pretty good set of earnings this quarter.
Well, the most recent report was unbelievably good. They were better looking forward. They were way better looking ahead and into the foreseeable future. I mean, it was just a game changer for NVIDIA. They became briefly, maybe still are, but at least briefly, $1 trillion company. So there was like a very elite group there. So they are kind of owning this space right now. But so we'll see. Yeah, again, we'll see what this next report's going to be. It's going to be under a lot of scrutiny.
Yeah, Jane, you and I were talking off camera, off filming camera, I guess, about retirement savings. And my generation, I'm a Gen Xer, a lot of Gen Xers don't have, according to certain reports,
Right.
And again, these reports, they're samples. I don't know, we'd have to talk to some statisticians, but in any event, Gen Xers don't have the retirement savings that maybe they should. And that's a bit concerning.
It is a huge concern because the older Gen Xers are about 10 years from retirement, not that far away. And you're really counting on the stock market to do well, or, the economy to do well if you're hoping. So this particular survey said 40% of Gen Xers had zero money saved. And it was another 40% had an average of 40,000. Which isn't going to get you very far in retirement. So while these surveys vary in terms of the amount, the percentages and things like that, they all kind of have the same headline, which is Gen X doesn't have enough money saved for retirement. So you ask yourself, what does that mean? I'm a Gen Xer too, by the way. So we're going to be longer than we maybe want to, maybe more government reliance, I don't know. I mean, all of a sudden, like retirement, like just jumped ahead of all of us, I think.
Yeah, well, you bring up a really good. Yeah, I'm sorry to jump on you, Jane. I guess it's obviously disconcerting. I think about the upcoming wealth transfer from boomers that could conceivably, as the boomer generation kind of moves on and retires and passes on, they're going to have a considerable amount of wealth, probably the largest wealth transfer ever in this country. So that could help Gen Xers and other generations. But still, I don't think you want to rely on that. And if you just have $40,000 in retirement, you're going to be unretiring very soon.
Absolutely. I mean, and I know some of my friends' parents who have retired too early. And all of a sudden we're like, okay, I got to go back to work. I mean, they really misjudged how much they needed to live. So it's scary, what we're facing here. But yeah, you don't want to count on other entities to pay for your retirement or even your living. Because you never know what's going to happen. I mean, even if you might inherit some money from a family member, there might be family infighting. It might take longer to get than you expect. Who knows? It's just best to kind of have your own little nest egg, and that other stuff is icing on the cake.
Yeah, well, I think the exclamation point is what happened in France. Obviously, we don't have time to talk about that, but I think that is the perfect example when you reduce benefits or raise retirement age, and you're dependent on an entity, like you said, to provide for you. When they go to cut it back, and ultimately it's at the will of the voters, wills, depending on which way the air blows, the will can change. Jane, always great to see you. Great discussion as always. Enjoy the rest of your weekend, and we'll talk to you again very soon.
Talk to you next week.
Thanks, Jane. Great to see you. Thanks for sharing your perspective. We come back, we take a look back at some of our best segments for the week. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. This week we discussed building more resilient DC plan equity exposures. Let's take a look.
Yeah, so pre-pandemic, let's keep in mind inflation was very low for a long time. And so, this idea of worrying about inflation and economic cycles, it's relatively a relatively new thing for many investors. Traditionally, investors have tried to include a number of different things to ward off the effects of inflation. I'm not a big fan of the term inflation hedge, because the more you study that, the more you realize it really doesn't exist. But some of the things that have been tried are, Treasury and inflation protected securities, or TIPS, REITs, and even commodities and metals and mining stocks. So this can be confusing for DC plan fiduciaries. Do you try to include one of these options in your plan lineup, knowing that you're going to have many participants that just simply don't know how to use them? Unfortunately, the track record for these standalone single asset class inflation-oriented options isn't good. Plan Sponsor Council of America keeps data on some of these smaller asset classes. It's very helpful to look at. And last year, they showed that 24% of plans offered a TIPS option, but it only captured 0.4% of assets on the aggregate. And if you look at REITs, it's very similar.
So there's nothing that explicitly controls for inflation when you need it most, right? That hedge of inflation shocks or unexpected inflation. So really the best tool that you have is investing in assets, some of which Greg mentioned, that have some linkage to, for the most part, realized inflation or its knock-on effects. So really what we have to think about, or the bigger issue, is that most asset prices are driven by a much more complex web of effects. Meaning, even if your inflation linkage works, right, you have to make sure that there aren't any other forces that overwhelm or impact the way the price of that asset still moves. So to keep picking on TIPS a little bit, in 2022, you had a great example of this. So while TIPS are explicitly linked to CPI, there's really only a very low correlation between TIPS and unexpected inflation over the long term. So last year, you saw a double-digit loss from TIPS because it was the duration risk that overwhelmed the inflation protection property, given the move in real rates. So that's just one example. You just always have to take into consideration that there are other factors that are going to impact asset prices, and those are going to run really a complete gamut of fundamental news. So you're thinking about things like inflation, but you have to consider what's going on in monetary policy. Have there been any fiscal policy changes? Corporate news for things that are connected to corporations, and of course, global financial shocks. And that's just naming a few. There's no crystal ball. Nobody can perfectly anticipate market shocks. But what we can do is think about how to overweight or underweight certain asset classes, certain regions, certain sectors, based on how we think they may perform at various stages of the economic cycle more broadly. So whether we're in expansion, slowdown, contraction, recovery, a macro regime framework that anticipates which one of those four stages we may be in, then can be very helpful with trying to outperform the broader market. So if we bring this back to inflation, then inflation tends to rise during the early stages of the cycle and fall in the later stages. So you could see that a cycle-driven framework may help position then for those environments. But again, it's not just about inflation. We really want to think about a broader macro regime framework to be helpful for allowing investors to position, again, across multiple asset classes, across multiple sectors, as they look to navigate the business cycle. We also think that this type of approach, a macro regime framework approach, can be very interesting when thinking about a single asset class. So something like equities, which are very cyclically sensitive, right? We're always kind of thinking about how our consumer staples going to do versus consumer discretionary. Do we want to be in growth or value? Do we prefer large cap or small cap? So a process like this then allows investors to just explicitly introduce that business cycle awareness into something that already exists in their portfolio, which is equities. And so what it allows then is for a more dynamic allocation to what may and may not perform well based on the expectation of where we will be in the business cycle. So this allows us then to think beyond just inflation and have a more comprehensive way to factor in all those economic risks, or as many as we can capture, like the impact of inflation, and have a better sense of what could drive asset prices.
The challenge is that one style typically doesn't perform well throughout an economic cycle. This can be true of a standard equity index as well. So, and they're all great tools in a diversified portfolio, but the problem is that some investors, including many DC participants, are not diversified and tend to be overexposed to one style. The type of strategy we're talking about dynamically changes its exposures based on macro indicators, as Danielle so eloquently described. It provides participants a chance of good returns in a variety of market environments. And because our strategy is rules-based, we're able to look back in time and compare how our model predicted these macro regimes to what actually happened going back to 1989. And what it shows is that this type of approach can work in a variety of economic environments. No model is perfect, of course, but the data shows that during periods of more subtle economic change, like after the Eurozone debt crisis, right on the heels of the GFC, as well as volatile periods like what we experienced more recently, that the framework held up. And what this all means is that there are viable new approaches to equities that can be included in DC plans at a reasonable price to improve participant outcomes. Dynamic, multi-factor funds that change their exposures based on those economic indicators.
And finally, are the retirement and financial services industries meeting their DE&I goals? Let's take a look.
So I'll say that I'm extremely optimistic about the progress that we've made so far in our industry and that we're continuing to make. We're really working to make financial services more inclusive. And so when I think about Secure 2.0, for example, and the focus on expanding coverage and increasing access, that certainly is moving the needle toward achieving financial security and independence for all Americans. In particular, when I think about diverse groups and community of color, the auto enrollment, auto escalation, in-plan guarantees, and emergency savings, those features and benefits will have a direct impact on diversity, equity, and inclusion goals.
Yeah.
We know that.
I'm sorry. Go ahead. Go ahead. I'm sorry, Kamika.
I was just going to say that we know that for many people, their employer's retirement savings plan is their primary vehicle to create wealth. So it's really important for our industry to invest in the systems, research, and tools to help more people close the wealth gap.
Yeah, I think, maybe I could just piggyback on some of the comments that Kamika made, because she was spot on, and I share her optimism. Certainly, the wealth gap amongst minorities has been persistent. They're very stubborn, and there are a variety of reasons for it. But the primary is financial exclusion that still exists within these communities. And to Kamika's point, retirement savings is the primary vehicle for most Americans, particularly African Americans and minorities. And the idea of Secure 2.0, reducing that coverage gap, has been the industry's primary objective, right? So think about the advocacy work that went into it. That's the outcome of the industry shaping those policies to make sure that there's broad coverage. 50% of private sectors never had access to retirement vehicles, never participated in it. And the people that were directly impaired were minority-owned businesses and women-owned businesses. So we think that the industry can do certainly a lot more than they have. I think this is the beginning of reversing some of the trends that we've seen for the last 4 years or so.
Yeah, thank you. And you're right, this is so important. Attracting a diverse workforce is key because representation matters. And we all know that there are studies that show that when you have a diverse and inclusive organization, you're much more likely to achieve better business outcomes. And so specifically for Lincoln, and what I know that many organizations are doing in our industry, we're setting goals and we're really being intentional about attracting and retaining a diverse workforce, because attracting is just one part of it. And so we specifically at Lincoln have diversity recruiters who are dedicated resources who are really focused on building a pipeline of qualified, diverse talent.
Yeah, I mean, listen, that's part of our engagement in these minority communities. I think, you think about access to capital as an important step to improving financial inclusion. You think about what our shareholders are doing to hold us as a company accountable, and with our ESG initiatives, D&I is at the very heart of that. And we work with Thurgood Marshall, United Negro Fund, to create opportunities, surely introduce them to niche and part of the financial services industries. Take the wholesaler industry as an example. It's been a very exclusionary profession. Having said that, it's a very lucrative profession for an individual that want to get into it. So we work with the organizations like Association for Wholesaler Diversities in partnership with all of our competitors in this space to recognize, recruit, retain, develop these individuals so they can get introduced not only into this marketplace, but they get an opportunity to be successful because of the mentorship and support that comes with it. So we're very, very much engaged, and it's at the forefront of our priority as an organization.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, visit our website, and of course, all of our streaming partners. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, financial services, and government as we break down all the important news and events for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Tax audits, tax liens, wage garnishments.
Every day we hear stories like this about good folks who are simply struggling to pay their bills. Each of them are living a frightening IRS tax nightmare, and they are afraid it will destroy their lives.
I'm a divorced single mom, and my ex-husband left me and the kids with a lot of unpaid bills, including unpaid taxes. I was really starting to show my stress on my kids because the IRS had sent me a letter demanding a huge payment from me. I couldn't afford it. So then the IRS was threatening to garnish my wages. I'm already living paycheck to paycheck. That would have put me over the edge financially.
It truly seemed hopeless, but then a friend at work told her to call the tax relief line.
The people at the tax relief line, they told me about something called innocent spouse relief. They worked it out so that all of the taxes from my ex are not my problem. I don't know how that works, and I don't care. All I care about is that I don't owe the IRS a dime, and they are not going to take my paycheck.
Even if it seems hopeless, you should call the number on your screen right now. There is absolutely no cost for the call or the consultation. You are under no obligation. If you are worried that the IRS could garnish your wages, seize your assets, even take your home, call us right now. The Tax Relief Line is here to help you. Now you have a knowledgeable, professional team of tax experts that are ready to negotiate with the IRS and fight for you to save you money. The Tax Relief Line's professionals have successfully negotiated thousands of cases, reducing and sometimes even eliminating the tax debt for their clients. It's very easy to get started. Simply call the number on your screen right now. You don't have to live in fear anymore. The call and the consultation are free.